You know that feeling when you look at the stock market and it just looks like a roller coaster plunging down?
Mm-hmm.
That pit in your stomach watching your money, your hard-earned money, potentially shrinking, it's really unsettling.
Oh, absolutely. That uncertainty during market swings, it gets to everyone, I think.
Right. And you can't help but wonder, okay, what are the people who've, built up real wealth doing right now? Are they just hunkering down like us?
Well, what's interesting in the sources we looked at for this deep dive is that they suggest something, well, quite different.
Yeah, it seems they paint this picture of wealthy people not just like weathering the storm, but actively moving their money around, even finding ways to potentially profit when things go sour.
Exactly. It's a really proactive stance we saw in the material. They're shifting focus. It's not just defense. It's also about spotting opportunities.
Okay, so that's our mission here then. Using these sources you've provided, let's treat and, pull back the curtain on that playbook.
Mm-hmm.
We want to unpack what the sources say are the key moves wealthy people make in a crash, and maybe even more interesting, where these sources think the smart money might be heading in 2025 for potential growth. We'll dig into the specifics, the examples, the data they shared.
Think of us as your guides through this pile of info. We'll help you sift through it and pinpoint the really useful takeaways.
Okay, great. Let's dive in. So first off, this mindset piece. The sources suggest wealthy investors aren't just sitting on their hands when markets tumble.
Not at all. The core finding seems to be this deliberate, proactive shift. They're moving funds.
It's not just hoping things get better.
Right. The sources suggest they see a downturn as, well, just a phase. And their goal seems to be twofold. First, protect the capital they have.
Makes sense.
But also position themselves for the rebound, for future growth when the market eventually turns around.
Okay, so when the panic selling starts, where do these sources say the money flows first? For safety. There's one asset that kept coming up called the timeless king in some of the material, gold.
Ah, yes, gold. Its appeal really lies in its history, doesn't it? The sources point out how resilient it's been through all sorts of major global crises, wars, economic meltdowns, high inflation periods.
Its value holds up.
Generally, yeah. Based on the data we saw, its value tends to hold steady or even climb when traditional markets are shaky.
And there were some pretty stark examples in the sources. Like during the 2008 financial crisis, the S&P 500 just cratered, down over 50%.
Mm-hmm. A huge drop.
But gold, according to these sources, actually gained 25% during that mess.
It really was a safe harbor back then.
Yeah.
And the material also mentioned its role more recently during the Russia-Ukraine conflict. Global stocks got really choppy.
Yeah.
And you saw capital flowing into gold, pushing the price up as investors looked for somewhere safe to park their money.
The sources also dug into why physical gold is favored. It's because its value isn't really tied to one single country's, currency or government decisions.
Exactly. The example given was pretty clear.
Mm-hmm.
Even if, say, the new Taiwan dollar were to drop sharply or the local stock market crashed, the physical gold bars or coins you actually hold would still have value based on that global gold price. It's sort of independent.
And for listeners in Taiwan, the sources mention it's actually pretty easy to get hold of. Banks, jewelry stores.
That's right. But they also highlighted a possibly more convenient route for some. Gold passbooks.
Ah, the electronic option.
Yeah, the material mentioned Yushan Bank as an example. It basically lets you own gold without physically holding it. You can trade based on real-time prices, and the minimum amount can be tiny, like just 1 gram.
Wow. And the fees, the sources said they could be pretty low, like NT $10 a trade, possibly?
Potentially, yes. And a big plus they pointed out for these passbooks is you skip the whole headache of storing it safely.
Right, no need for a safe deposit box or worrying about theft.
Exactly. And you can convert your holdings back to cash pretty much any time based on the going rate.
Okay, but for actually buying physical gold, the shiny bars and coins, the sources had a really important warning, didn't they?
They did. A crucial one if your goal is purely investment. Steer clear of gold jewelry or those fancy collectible coins.
Likes that.
Well, the sources warned about the high markups, processing fees, design costs, and the buy-sell spread. The difference between what you pay and what you get back immediately is usually much wider.
So it makes it harder to actually make a profit.
Much harder. Those costs eat into potential gains.
Yeah.
The advice was really clear. Stick to investment-grade bars or basic coins valued just for their gold content.
Got it. And if you do go physical, storage isn't free or risk-free either, the sources noted.
No, definitely not.
Oh.
Storing it at home, you've got the theft risk. The sources suggested thinking about a good safe, maybe even monitoring.
Or the bank.
Or a bank safety deposit box. That's secure, but costs money every year. They cited a figure, maybe around NT $1,200 annually, for a small box at a bank like CTBC, for instance.
Okay, so gold is one major safe haven. What else did the sources point to? Another big one was the US dollar.
Ah, the dollar, yes. Its safe haven status really comes down to the U.S. being the world's biggest economy and the dollar being, well, the main currency for global trade and finance.
So when things get globally shaky,
The pattern shown in the sources is pretty clear. Money tends to flow into the U.S. dollar. Investors see it as relatively stable.
like during the start of the pandemic.
Exactly. Global stocks were tumbling, but the USD index, which tracks its value against other major currencies, it actually surged.
And the strategy the sources described, it involves people exchanging their local currency, like TWD, into USD during the crisis.
Yeah, to basically preserve the value of their assets while things are volatile. Then potentially, if the TWD recovers against the dollar later,
They switch back and pocket the difference.
that's the idea. Profit from the exchange rate swing. And in Taiwan, swapping TWD for USD is generally quite straightforward at banks and exchange counters.
But like gold, it's not without its own considerations. The sources flagged a couple of key things. One was interest rates.
The difference in interest rates. They gave an example. A USD fixed deposit might only yield, say, 0.5% annually at a bank like Taishin.
Which is pretty low.
Right. Meanwhile, a TWD fixed deposit for the same term might offer something closer to 1.3%. So, by holding USD, you could be missing out on better interest earnings elsewhere, like in TWD.
That's opportunity cost. And the other big factor was the exchange rate itself just moving against you.
Yes, volatility cuts both ways. They had that 2023 example where the TWD actually got stronger against the dollar, moving from about 30.5 down to 29.2.
So if you'd swapped TWD for USD at the start of the year,
And swap back at the end, the sources calculated you'd have actually lost around NT $43,000 on a million TWD just from the currency movement alone, before even considering interest.
ouch. So the takeaway seemed to be that using USD for hedging is maybe best as just one part of a bigger diversified strategy.
Precisely. Not putting all your eggs in the USD basket, but combining it with other assets seems to be the recommendation from the sources.
Just spread the risk.
Exactly. And they did briefly mention, for those wanting to get more sophisticated with managing that currency risk, there are things like Forex futures or options, but those are more complex financial tools.
Okay, so we've covered the defensive plays gold, USD, that the sources say wealthy investors use during a crash. But then things get really interesting, maybe even a bit counterintuitive. The sources look ahead to 2025 and talk about opportunities.
Yeah, and this is where they challenge that common advice you always hear, don't try to catch a falling knife.
They actually say it's not necessarily wrong to buy stocks during a crash.
That's what the material explicitly states.
Wow. So instead of running away, the strategy is to see the crash as a buying opportunity.
That seems to be the perspective highlighted in the sources. Downturns are viewed as chances to pick up shares in top companies, but at a discount, specifically focusing on what they call growth sectors or trend sectors.
And which sectors did the sources flag for 2025? Areas like new energy, semiconductors.ai.
Those are the key examples mentioned. Sectors that, according to the sources, have significant long-term growth potential, sort of irrespective of short-term market noise.
Let's dig into that semiconductor example they used from Taiwan, TSMC, for instance.
Right. The point the sources made was that even if a fundamentally strong company like TSMC sees its share price dip during a wider crisis,
Yeah.
its underlying strengths, like its tech leadership and global demand, mean its value is likely to recover and grow over the long haul.
And dividends play a role too, right? The sources mentioned that. Even if the stock price is down for a while, you might still get income.
Exactly. They cited TSMC's dividend in 2024, NT $12, which was about a 3% yield at the time. So you're getting some return while you wait for price recovery.
And they even gave specific price numbers for TSMC during that 2022 volatility, dropping from around NT $688 to NT $450 before starting to climb back.
Illustrating that dip in recovery potential.
And this is a big, but the sources were also super clear. Buying stocks is risky. This isn't advice to just blindly jump in because prices look cheap.
Absolutely not. That's a crucial disclaimer. The sources actually went into detail about how to select stocks. They stressed doing your homework.
Researching fundamentals?
Yes, digging into the company's health, revenue, profit, gross margin, EPS, its earnings per share, a key profitability metric.
And combining that with looking at the charts, technical analysis.
Right. The sources mentioned using tools like moving averages to see price trends, and the RSI, the Relative Strength Index, which they suggested can help gauge if a stock is maybe overbought or oversold.
So a mix of fundamental strength and timing.
Kind of. And maybe the most important risk management tip they offered for stocks was diversification within your stock holdings.
Don't just bet on one horse.
Exactly. Spread your investment across, say, 3 to 5 leading companies, ideally in different sectors, so if one area hits a rough patch, it doesn't sink your whole stock portfolio.
Okay, that makes sense. Now, shifting away from stocks, the sources flagged another investment that's apparently still very much favored in Taiwan for 2025, real estate.
Yes, property. The material definitely notes its continued popularity, particularly properties in those prime spots in the big cities, Taipei, Taichung, Kaohsiung.
Why prime locations specifically?
They're highlighted as being more resilient, less prone to big price drops compared to other areas, according to the sources.
They used Taipei's Xinyi district, the luxury end, as an example, didn't they? Saying prices there barely dipped in the financial crisis.
That's right. Only a slight correction reportedly before prices recovered and then shot up to new highs during the rebound.
And they backed that up with some official data.
Yeah, Ministry of Interior data cited showed average prices in Xinyi around NT $1.5 million per ping in 2024. Recent annual growth was pegged around 10%, and crucially, the dip there back in 2008 was apparently only about 5% compared to maybe 10-15% drops elsewhere.
Interesting. And the sources talked about 2 ways to approach real estate investment. Living in it yourself.
Right, so you save on rent, plus you benefit from potential appreciation.
Or buying purely to rent it out for income.
Generate cash flow from tenants. They gave an example from Taichung's 7-3 development zone, a 30-ping studio, potentially renting for NT $20,000 to NT $30,000 a month.
And they even did the math, didn't they? Showing how that rent could help cover the mortgage.
They did. Walk through a scenario. A NT $15 million place, 30% down payment, leaves a NT $10.5 million loan. At, say, 1.8% over 20 years, the mortgage is roughly NT $58,000 a month.
Okay.
So if you get NT $25,000 in rent, it significantly cuts down how much you need to find each month.
But another big but. Here the sources were very upfront about the challenges. Real estate needs serious capital upfront.
Oh yeah, the barrier to entry is high. Huge down payments needed. And they also pointed out the whole process is complex, lots of steps.
And costs involved in just buying or selling.
Significant transaction costs.
Yeah.
They listed things like deed tax, maybe 6% in Taipei, stamp duty, broker fees, often around 3%, mortgage fees. It all adds up.
Plus, if you have a mortgage, you're exposed to interest rates going up.
That's always a risk, potentially increasing your monthly payments down the line.
So the advice on real estate from the sources seemed to be, really check if you can afford it. Make sure you have that solid down payment saved up first.
Prudent advice. Now, we've hit physical assets like gold and property, financial assets like stocks and UST, but the sources highlighted one other investment area.
Ah, yes.
One they positioned as perhaps the most profitable and stable, especially looking ahead to a fast-changing 2025.
Investing in yourself.
Bingo. The sources really emphasize this. In any economy, but maybe particularly now, constantly learning, acquiring new skills. That's presented as the surest way to boost your own competitiveness, your earning power.
And they gave practical examples, right? Like learning languages, taking online courses.
Yeah, things like Japanese or English to open career doors. Online courses in fields where demand is hot, like digital marketing or coding. Even attending seminars or workshops for networking as much as learning.
And they mentioned some local resources like Jumbo English, giving an idea of costs maybe NT $5,000 to NT $20,000 for a course.
Right. And the key point was the potential return on that investment. Relatively low cost upfront.
But potentially huge upside.
Potentially infinite, the sources suggested. They had that striking example. Spend NT $10,000 learning to code, maybe land a job, paying NT $20,000 more each month.
You make back your investment in less than a month.
Exactly. And the increased earning potential just keeps going.
And the big benefit, the sources stressed, is those skills are yours for life. They make you adaptable, whatever the market does.
Resilient. So if you tie all these different threads together, the safe havens, the strategic investments, the self-improvement, there's one principle the sources kept circling back to.
The one rule to rule them all.
Pretty much. They identified it as the absolute most vital rule for any strategy, whether you're playing defense in a crash or looking for growth in 2025.
Let me guess. Diversification.
You got it. It's the classic advice, isn't it? Don't put all your eggs in one basket. But the sources really hammer home its importance.
So spread the money around.
Across different types of assets. Hold some gold, some stocks, some USD, maybe some bonds, and always keep some cash accessible.
And the benefits are pretty obvious when you think about it. If one thing tanks.
Hopefully the others cushion the blow. Your overall wealth doesn't take such a big hit.
Plus, you're positioned to benefit from different markets performing well at different times.
Exactly. Stocks might be up one year, real estate the next, maybe gold has a good run. If you're diversified, you potentially capture gains across the board. You're not reliant on just one thing doing well.
The sources even laid out a sample portfolio, didn't they, for like 1 million TWD?
They did, just to illustrate the concept. It wasn't prescriptive advice, more a demonstration.
How did they break it down?
It was something like 300K TWD in a gold ETF that's an exchange-traded fund, an easy way to get gold exposure via the stock market.
Okay.
Another 300K in those leading growth sector stocks we talked about. Then 200K in a USD fixed deposit. 100K in government bonds, generally seen as lower risk. And the last 100K just held as cash for emergencies or opportunities.
So a clear split across different types of investments.
A very clear example of spreading the risk and potential reward.
Okay, so let's try and wrap this up. Pulling together the main messages from this deep dive into the sources. It seems like market downturns, while scary,
Definitely daunting.
don't have to be paralyzing. By understanding these strategies using safe havens like gold and USD, strategically buying good stocks or real estate when prices dip, and maybe most importantly, investing in your own skills, the sources suggest you can actually protect your wealth and maybe even find ways to grow it.
And underpinning all of that is diversification. That seems to be the absolute key takeaway. It's both the safety net and the way to make sure you don't miss out on opportunities.
Which leads us to a final thought for you, our listener, based on everything we've just explored from these sources. The next time the markets get choppy, that roller coaster feeling starts. Instead of just reacting with panic, what's one specific step, drawing on these insights, that you might consider taking? How could you start to follow the playbook of those who navigate these times successfully and keep building their wealth?